there, and I'm still on the video. Perfect. Fantastic. So yeah, thanks for everyone who is attending. Really excited to be doing this. Got over my nerves, so I'm feeling much better about it. Always get nervous before these things. But basically the aim of the webinar is to take you through some strategies around paying less tax, how you can maximize your pension, with the ultimate goal of obviously achieving financial freedom. So just a bit of a background regarding myself. I'm a financial planner. I set up my own business about 3.5 years ago called Work to Live Financial Planning. Been advising for over a decade before that, and I work predominantly with business owners and sort of senior level executives, around building their, financial life plans, helping them get their pension sorted, their investments sorted, but all in the service of living kind of a great life. So that's really the ethos behind what I do. So just some caveats. This presentation is for information purposes only. It shouldn't be taken as financial advice, which should be dependent upon your own personal circumstances and your needs. So if you do need financial advice, I recommend that you speak to a trusted financial advisor, such as myself. But yes, a lot of information to kind of go through, but obviously important that, you take advice, and appreciate it's for information only. So just a little bit of a tick there in terms of the compliance side of things. Okay, so the agenda we've got for today, basically got 3 sections that I'm going to really sort of cover off. Ways to potentially pay less tax. I'm going to talk quite a bit around how to maximize pensions, talk around financial freedom and how you can go about achieving that, share my kind of top 3 sort of takeaways, and then hopefully some Q&As at the end if we've got some time, or obviously if people have got some as we go. I will check off through each kind of section as we're kind of going along. Unfortunately, I can't kind of see how many people are on the actual thing at the moment. I'm going to say, hopefully it's not too much sort of death by PowerPoint. There is quite a lot of information. There's a lot of things to kind of cover off and try to make it as easy to digest as possible. But yeah, some of the slides have quite a lot on them, but I'll do my best to kind of explain it. And if anyone has any kind of queries as we go, just sort of ask away in the chat side of things. Okay, so I thought really useful to sort of have a recap. A lot of changes over the last, 6 to 12 months. Lots of, spending reviews, budgets, and all those kind of things. So since the last budget, there have been quite a few kind of changes with regards to what's going on with regards to our tax. So the first one, the freezing of the income tax bands, essentially keeping them at the level they are, which is going to put small people into different probably tax bands just through kind of inflation and any wage growth. So, for example, the personal allowance is being locked in at 12,570. Same for the 20% and the 40% bands are at the same amount. So although not tax change percent in itself, it's obviously going to put more people into paying a different level of tax if they've had any kind of wage growth. So a big change kind of there. Reduction in the additional rate threshold. This is the point at which you start paying 45% tax. It was previously 150,000, has now dropped down to 125,000. So quite a significant change in that. And again, it's going to force more people into potentially being in that higher rate kind of tax bracket as well. Then we've got the reduction in the dividend allowance to £1,000 from the 500. And then to 500 in the next tax year. You'll kind of probably see a reoccurring theme with regards to these tax changes. It's all about them obviously being able to get more tax in with the pressures that they feel like they are under. Capital gains tax allowance been cut kind of substantially from 6,000 to 6,000 this year, and then again that's going to reduce down to 3,000 in the next tax year. Just regarding the slides, can't send out the slides, but there will be a recording that's sent out. So if you drop us your email, probably best doing it on LinkedIn Messenger, Sandeep, I will make sure that the recording is sent out to you, so you'll have not a copy of the slides, but obviously you can go back through and check them. No great surprise. The inheritance tax band frozen at the nil rate band. It's been like that for years, and not particularly pertinent to majority of my clients, who tend to be sort of younger in their sort of in their 40s and 50s. But again, something to kind of be aware of on that side of things. And then I think the biggest change, and certainly one of the more surprising ones, was the changes that they made to pensions and the increase from the in the pension annual allowance from 40,000 up to 60,000. It's obviously a positive step for people who want to be contributing more to their pensions. They've also removed the lifetime allowance, which is the total amount that you can accrue in a pension. Without there being sort of a tax implication. I've not covered off the lifetime allowance in this presentation. It's just there's too much to kind of go through, but it is something to be aware of for people who have accrued previous pensions. We were kind of hoping from an advisor point of view that it was going to be sort of a bit simpler. But because they've now capped the amount of tax-free cash that you can get, if people do have protection around previous allowances, again, it's probably going to be an advice area that you need to look at on whether you want to keep it or not. And obviously the concern being that if there is a change of government with regards to that, if Labour came in, they've already said that they want to kind of probably put that lifetime allowance in, but we can only go on the basis of what we know at the moment. But some big changes around pensions, so that does give some opportunities from a planning side of it, from a financial planning side of things. And then certainly pertinent to any business owners, headline rate increase in the corporation tax to 25% for any profits over 250,000. I'll cover this off in more detail, but again, big increase in the corporation tax. So for business owners, again, making some of the other avenues more attractive with regards to, potentially pension planning, for example, with that big kind of increase. So it really is a big change in terms of it's just a chance for them, they've reduced the allowances, obviously trying to increase the tax take. So it just means that people in general are going to be paying more tax moving forward. So what are some of the ways that you can actually, sort of pay less tax? Although they've removed a lot of these allowances or reduced these allowances, there are some still available. Marriage tax allowance, which is often overlooked by people. Perhaps if your spouse isn't earning or working, this can be an option for you. If you've not claimed that, I think you can go back and actually claim for previous years as well. Everyone's got a personal savings allowance that they have. Again, this is something that is reduced based on your tax rate. Previously wasn't a massive issue because if you were getting interest in a bank account, there wasn't actually probably getting much interest. So it wasn't really causing you an issue. With the interest rates the way that they are, with them being higher, then it's potentially that you obviously start paying tax on things that are held in sort of normal kind of current accounts. So definitely something to consider whether there would be a more suitable avenue if you're holding money in cash because of the changes. Saving rate band apply to a lot of people, but it's another allowance that's available. Everyone gets an ISA allowance each year, which I'm going to cover off in more detail. We've got the dividend allowance, we've got the capital gains tax allowance, and the pension annual allowance as well. Obviously, a lot of these have been reduced, dividends and capital gains taxes, especially, but the pension allowance has gone up. And again, options around that. So to use tax efficient investments, things like your ISAs, pensions, EIS, VCTs where appropriate. I'm going to cover those off in a little bit. Potentially investment bonds now because of the changes with regards to capital gains tax. It may be that investment bonds become more suitable if you're holding, assets or have investments. For example, an offshore bond, you don't pay any tax within the bond. Onshore, you're paying tax within it, but potentially when you come to make a gain on it, you might be paying less tax. So for most people, it's still probably going to be, investment accounts and using your capital gains tax allowance, but it's definitely another consideration and something that should be looked at. If you're holding significant assets, investment bonds have maybe come more into play because of the changes than they had been previously. Okay, so if we cover off the ISA allowance first, really just a chance to kind of clarify a couple of things and some of the questions that I kind of get asked by my clients. So every year you do get a new ISA allowance. You're allowed to put £20,000 into an ISA. Okay, in each tax year, there's various kind of ISAs that you can use. You've got your cash ISAs, your stocks and shares ISAs, something called a lifetime ISA, and innovative share ISAs as well. Slightly different in terms of the lifetime ISA, how much you can put in, but in most cases you can put 20,000 in total. So you can have a cash ISA and a stocks and shares ISA, but you couldn't have 20,000 in each of them. It's 20,000 total allowance for the year. And if you've got a partner or a spouse, they also have their allowance as well, another 20,000. So potentially between two of you, you could be putting £40,000 into ISAs each year. Really tax efficient, no tax to pay on any income or any gains within the ISAs as well. So when you're pulling money out, there's not going to be any tax to pay. So really, really efficient and really sort of a staple of financial planning that you want to be using where you can. Excuse me. So now we'll move on to the capital gains tax and the dividends. As you can see, big reductions in terms of how much capital gains allowance you're going to have, and again with the dividends. So there is some available, but it is massively kind of reduced. Okay, so although there is that reduction, there is still some planning opportunities with regards to capital gains tax. It's something that you really need to look at now as soon as possible, if it's something that you can take advantage of, because obviously if it's reducing in the future, it's gonna can be harder for you to exploit any opportunities. So one of the things that can consider is if you've got assets that you could actually transfer to your spouse or your civil partner, that there's not subject to capital gains tax on any transfer of those kind of assets. So there won't be any capital gains tax to pay if you move them across, which means if they've got like an available allowance that you could potentially sell the gain and then use up their allowance so that there isn't any tax to pay. So, a really good way of doing some kind of tax planning as well. Also, if they are potentially paying a lower rate of tax, say you've got an income producing assets, for example, I have a client who has some rental properties. One of the rental properties is held in his wife's name, who is a high rate taxpayer, actually additional rate taxpayer. Because they're not working anymore, it makes more sense for him to hold the property in his name, which can be obviously transferred across without incurring any capital gains tax. And then for the income to be paid to him is going to be, quite significant, kind of a tax saving. So, there are opportunities around that. So you can sell any assets that you've got, such as stocks and shares, with a view to kind of then investing it in more tax efficiently as well. So taking advantage of the ISAs so that any gains are tax free. So really important to, kind of consider any, opportunities there are, and to do it while, the allowance is at 6,000, not as good as it was, but there is still some scope as well to explore things. So yes, definitely something that's, important to consider with the changes. Okay, there's quite a lot of information on this slide. I said, one of the options that people have is around enterprise investment schemes and venture capitalist trust. These are, high risk investments are not going to be suitable for a lot of people, and really should kind of be considered after your pensions and ISAs. But there is an option there for people where it is suitable, particularly if they had reduced pension allowance, for example, because of how much they earned. But essentially, you get a tax credit 30% on your investments as long as you hold them for the appropriate period. So, for example, if you had 100,000 invested, you get a £30,000 tax credit. So this reduces your tax liability. It doesn't actually reduce your income, but if you had £100,000 tax bill, but you had a £30,000 tax credit, you'd only have to pay the 70,000. Both free of capital gains after the holding periods, which are different for each of them. VCTs, dividends are exempt from income tax. Various things you can defer capital gains, and if you made a gain, you could potentially invest that and defer it to later on when hopefully you may maybe pay less tax. But say not appropriate for most people, but particularly high earners, it's definitely something to be considered after kind of maximizing out your pensions and your ISAs. But really, probably an area that you want to be taking, financial advice on and make sure that they're suitable for you. But it is an option for you. Okay, so the one area that often, again, overlooked by people is around their personal allowance. So everyone has a tax-free personal allowance, and that is 12,570, which we've discussed is being frozen. What actually happens, and a lot of people don't realize this, is that if you earn over 100,000, your personal allowance starts reducing quite substantially. And then if you earn over essentially 125,140, you would lose your entire tax-free personal allowance. And then actually the 45% tax rate then kicks in. But your effective rate of tax between those points is 60%, because you're losing your allowance and it's putting you into the higher rate of tax for you to have to pay. So big tax savings if you are able to put into a pension at that point, because it can actually make you be able to reclaim your allowance. So really, really important planning area for people who are earning over that £100,000 mark is to make sure that, you know, you're taking advantage of pensions around your personal allowance. And just by way of example, a case study or a client that I had, who's an IT contractor, earning over that £100,000 in the tax year, hadn't used any of pension allowance, and what we did, we invested a lump sum. So he invested himself 20,112, and then that got grossed up to the 25,140. So obviously that's using up his band and his allowance that he's lost, and then through his self-assessment, he can actually then claim back the tax for and get additional tax relief. So for that pension contribution, it's actually costing him around £10,000 to get £25,000 in his pension. So it really is kind of a no-brainer for people who are earning over that £100,000 mark to get the money in there and take advantage of those, that tax planning opportunity. One thing to say also, to make sure that you do go through your self-assessment or make a self-assessment and claim back the further tax. There's a lot of tax that's left to the taxman that people could actually kind of claim, which they don't. So if you have made contributions and been hit by this with the earnings and pension contributions, where you've made personal contributions, you can go back, previous years that you haven't actually claimed. I think it's about 3, and make a claim. So it's definitely worth doing, because there's a lot of unclaimed tax out there on that side of things. So that's really our kind of the first section and covered off. If anyone's got any questions around that, if you want to throw them into the chat, I'll either answer them now or I'll save it till the end, and hopefully can cover it off then. Okay, just because I'm already running a bit behind schedule, I'll fire into the pension side of things, and ways that you can actually maximize the pension. This will have a bit of a slant towards business owners around what they can do with regards to maximizing pensions, but again, some of it will apply to executives, people who are employed and kind of higher earnings, but lots of opportunities around pensions. But as usual, it's not as simple as it perhaps could be. So we'll try and kind of work through it and get sort of clear on the opportunities. Okay, so just a little bit of a recap with regards to pensions. And in this webinar, I'm talking what is called a defined contribution pensions. Some of you may be lucky enough to have old defined benefit schemes, or really lucky and still be a member of them. But a defined contribution is something where you're essentially contributing yourself, or your employer is contributing as well, and you're building up a kind of a pot of money. So I'm going to be focusing on pensions where we're actually making those sort of contributions. So just a little bit of a recap. We've got the annual pension allowance of 60,000 in this new tax year. With regards to pensions, you can access them from, currently it's 55. This is actually being nudged up. So it might be 57 or 58, depending on when you get your state pension. So they're basically aligning it to 10 years before you're allowed to get your state pension. And of course, there's always talk that they're going to increase the state pension to, 70. If they did that, then you wouldn't be able to access it potentially from 60. So really important that people are aware of this, aware of these changes. And if there is a gap where potentially they're not working and they're going to need to be pulling down on their assets, to do planning around that, because you might not be able to get your pension until later than you think. Okay, so once you actually access your pension, you can claim 25% of that tax-free, subject to the cap that they've introduced because of the lifetime allowance changes. Anything else is taxable at your marginal rate. So the thinking behind that is hopefully, if you're getting tax relief at 40%, and then when you're taking it out, you're not working, so perhaps you're 20% taxpayer, that's where, there's a real advantage in terms of pensions and how they work for you. Okay, one thing to also clarify is what happens if you were to die. The pension does just pass across to your spouse or potentially your beneficiaries as a lump sum. You'd want to do a death nomination form within your pension, but it doesn't die with you. It can actually be passed across. And again, a planning aspect for kind of higher earners or people with assets. If you're in the right sort of pension, it potentially can be passed across and remain in a pension, which is going to bring certain kind of tax advantages. So it's certainly something to look into to make sure if you're in, what sort of scheme you're in and how the death benefits might be paid. And if that happens before the age of 75, there's no tax to pay on it. If it happens, if you died after 75, then whoever would withdraw it would just be taxed at their marginal rate. So again, really good vehicle from a tax planning perspective. Hopefully you get to spend it and enjoy it there, but it's something to cover off because it does get asked the question quite a lot by clients. The size of your pension is going to be determined by sort of various factors: how much you can contribute, how long you're invested, what the charges on your pension, what kind of performance and returns are you getting. That's really going to dictate, what you're going to end up with. And the sooner you start, obviously, the better. And then the annual allowance, as discussed, does reduce depending on how much you earn. So if you're earning over 260,000, then it starts getting reduced and you can't put the full amount in. But I'll touch on that in a little bit. Okay, and then just on the right-hand side, you can see the tax relief that you'd get if you're basic rate taxpayer, higher rate taxpayer, or top rate taxpayer, and how much it would actually kind of cost you on that side of things. Okay, so just to cover off the pension annual allowance and some of the rules around it. So you're allowed to put 60,000 into a pension subject to something called relevant UK earnings. Obviously, there's different things that make this up, but for most people, it's their salary. There are some additional things that could be there, so it's certainly worth understanding that. But basically, it's based on your salary. So if you were earning £40,000, the maximum you could put into a pension and get tax relief would be the £40,000. The 60,000 is an irrelevance. Again, if you earn over 260,000, the allowance is reduced down, and eventually it will go all the way down to £10,000. So this is an increase from what it was previously, where it was 4,000, but it's not a lot if you're obviously a high earner and wanting to make significant kind of pension contributions. Unfortunately, don't have time to go into sort of the taper pension allowance. It's probably something for another webinar in the future. But there are kind of options around it, and particularly if you're a business owner and you're perhaps more in control of how you're getting paid, there may be things that you can do on that side of it. But obviously, you need to be aware that the amount that you earn can affect your annual allowance. And then you can actually go back and use previous pension allowances from other tax years, subject to something called carry forward rules, and that's what I'm going to touch on, in a little bit. Okay, so just with regards to that, then, with regards to the pension allowances, we've got something called carry forward. So again, a bit more complicated than I ideally would like, but the way it basically works is if you've got unused allowance from previous years, you can go back and use it, and you can essentially go back into 3 tax years. So you see here the new allowance of 60,000, and then in the previous tax year, it's been 40,000 for the previous 3 years. Okay, so I'm just having a look at a couple of questions. I'll come back to those. So this is assuming that you've not made any previous pension contributions in previous tax years. Just notice there's a spelling error on there. You have to have been a member of the UK pension scheme in those tax years. You don't actually have to have been contributing to it, but you need to be a member within it to be able to go back and use your carry forward. The figures above are, again, assuming that you've not been subject to any taper relief in any of those years, and the level of income was lower in those previous years, so you could have been caught by that. So again, something you want to really be very careful on when you do your kind of planning. And again, you need to have the sufficient kind of UK earnings to be able to make these contributions. So how does it work? An example, really simple example. I've assumed that basically the client has put in 20,000 in each of the tax years. So there's an unused allowance of 40,000 in that tax years, and then 20,000 each of the previous ones. So if you add them all together, that client could make a lump sum contribution of £100,000 into a pension, which is more than obviously the personal allowance for this year. Obviously, they're subject to those rules that I've mentioned, and make sure that they've got that level of earnings. So if they were earning £60,000, even if they could put £100,000 in, they wouldn't be able to, because they haven't got the relevant UK earnings on that side of it. And again, just one kind of things to highlight, and again, it provides sort of further planning opportunities around it, would be the order of how carry forward works. So basically, if you make a pension contribution, it uses up your allowance for this tax year first. So, in the new tax year, you're allowed to put £60,000 in. So if you put 60,000 in, it would use up all your, current allowance. If you go back, then what happens is you actually go back to 3 years. So in the current tax year, that will be whatever you contributed in 2020, 2021, and then it would use up that allowance. So if, in this example, if a client put, an extra 60,000 in on top of the previous contributions, it would use up the pension allowance from this year, and then the pension allowance from 2020, 2021. And you still have a couple of years that you could use. So really good kind of opportunities where you may not be able to use the full allowance now, but you can basically stagger it over time, because what you don't want to do is obviously be able to make those contributions, and then the tax year kind of drops off when you could put in potentially an extra £20,000 in, or whatever it may be. So useful to kind of know how it works. And again, it might be something that you stagger because of how much you're earning. So if your tax rate is higher, you're obviously going to want to make the contribution at that point. So you want to make the contribution at 40% or 45%, as opposed to being able to get 20% relief on it, because obviously it's subject to how much salary you use. So again, really good opportunities, but a little bit complicated, and really an area to look at with regards to advice as well. And if you've got kind of tapering issues as well, if you were high earners, that might reduce your allowance. You need to be aware of that. Okay, so just some kind of key points, and just to clarify some things. So tax relief is basically relevant on personal contributions. It's limited to either 3,600 or 100% of your UK earnings. When planning to make large contributions, consider obviously, again, spreading across tax years, as it could be more tax efficient if more tax relief available at a higher rate. Employee contributions are not limited by employee earnings. So basically a really good opportunity for business owners or directors, but any contribution needs to be for wholly and exclusivity purposes of the business. Again, something to check with accountants, and in most cases it will be. But it does give you that scope if there's lots of money sitting within the business to make those contributions. Okay, whether it's personal, whether it's an employer, whether it's somebody else, third party, all counts to your allowance. So it's not just your contribution. If your employer is putting in 20,000, that is using up part of your allowance. Okay, so something to be aware of that. Obviously, lower annual allowance for higher earners. And if you're a defined benefit member, then you need to basically be aware of how those schemes work and how much of your annual allowance it uses. there's a particular calculation that you need to kind of take into account. So again, it's something to be aware of and something that you probably want to take advice. And one thing I would add as well is that if you make a transfer in that tax year, so let's say you had 40,000 that you transferred from one pension provider to another pension provider, that doesn't use up your annual allowance. Okay, so that is a separate thing. Okay, so just to try and make it a bit more understandable, so let's say that you've got a business, you want to take money out of the business, say you're a director, then that's going to be subject to tax. It might be income tax, dividends tax. You're going to pay corporation tax on the profit. So obviously it's going to net out at a lot less than what you're going to withdraw from the business, depending on obviously how much you earn and your salary. Whereas what you could do is have the business pay directly into a pension. That pension can come from pre-tax income, and then there's a deduction on the corporation tax as well. So the business has £50,000 in it. You could potentially move that £50,000 into a pension and also get the corporation tax relief as well on that side of things. So you don't have to pay it to yourself. The business can actually pay the pension. So it's a useful thing to kind of be aware of. And again, big changes in terms of the corporation tax rates increasing. So profit up to 50,000, you can stick at the 19%. Between 50,000 and 250,000, you'll basically get marginal rate relief, but it works out that it's effectively a tax rate of 26.5%. And then if you earn over 250,000, then you can go on to the headline rate of 25%. And you can see in the right-hand column, the reduction that you could get in terms of your corporation tax by, putting a lump sum in during these kind of amounts, obviously subject to all the rules. So pensions were very attractive before. They're even more attractive now, especially if your profits are going to be over, sort of £50,000 and you've got money sat in your business. So again, some key things to consider: your company accounting period. Working with an accountant. With most of my clients, liaise with the accountant around this and the best time to do it. Again, with the changes that are happening and how HMRC want it to be worked out, waiting later in the year could potentially mean that you're actually getting more tax relief. For example, I've got a client, if they do it in July, then it's going to be at a higher rate of corporation tax saving than if they do it straight away because of how the accounting periods work. Again, another advice area. Obviously you need to consider the pre-tax profit, how much is in the business. Is there scope to make these pension contributions? What else have you got going on in your life as well? Do you need to draw that money out? What allowance is available from the current year and previous years? What level of contributions have you made? So all these considerations that need to be taken into account as well. And then some other considerations. So if you're employed, for example, making sure you're maximizing any employer contributions. So you might have an employer that if you put in 5%, they'll put in 5%, but if you actually put in 10%, they'll match it at 10%. So sometimes, obviously, people are leaving money on the table, essentially kind of free money from their employer. So make sure you're maximizing your pension contributions at the very least, ideally up to what the employer would put in. Don't if they were going to put in an extra 5%, if you did, it's going to make sense to do that, and it's obviously going to build your pot longer term. Consider the investment choices. Often see that clients are just sat in a default fund when they kind of set up, particularly if they're employed. Might not be appropriate. Could you take more risk? What the charge is? What was the underlying investments? You want to really get clear on that. Make lump sum contributions where you can, potentially if that's employed. Again, bonuses, topping up your pension. If you've got a bonus that takes you past the £100,000 mark, probably really want to consider putting that into a pension, just from the tax relief perspective as well. Highlight again, make sure you're claiming your tax relief through self-assessment. Some interesting figures around how much actually unclaimed tax there is that people are entitled to because they haven't claimed it. And you might want to consider, consolidating your existing pensions, simplifying your financial arrangements, again, reviewing the investments, the charges, particularly if they're older schemes as well. Just to be aware that there may be, additional benefits or guarantees on it. So again, something to be, to consider, but you really want to make sure you've got all the information on the schemes. Just don't go kind of head first into consolidating these pensions. Okay, and then I wanted to share a case study that I did with regards to a business owners. It's a couple that both directors were in the business, had existing pensions, but weren't actually making pension contributions. Alongside the financial life planning that we did, we also did some tax planning and how we can reduce their corporation tax bill. And they invested a lump sum of £15,000 each, and we also set up regular pension contributions for each of them of 12,050, which we've just recently increased as well. So the corporation tax was actually reduced by 5,700 due to the lump sum in 1 year. That's assuming a 19% corporation tax, and if that was over 20 years, potentially that's £100,000 in corporation tax that they're saving by making these pension contributions. So just a really attractive vehicle for business owners, with all the other tax benefits as well. And then they're obviously building up their wealth each year by a minimum of sort of £30,000. The cash flow modeling that we did, shows that they're on track for financial freedom to be able to make work optional at 60, all from that planning. But as I say, for business owners, it's really a no-brainer. Often business owners are kind of like how to get money out of the business tax efficiently. Pensions is the way to go. More often than not, that's what you want to be doing, and it allows you to take advantage of the success the business is giving you from a profit perspective, and not be totally reliant on sales. So yes, speak to a lot of business owners, and it's often, in most cases, pensions are the best way to go. Okay, I'm just gonna take 2 seconds and just have a little look at that with regards to a couple of questions that I'll come back to on that side of it. So finally, I wanted to touch on financial freedom, achieving financial freedom. So work with a lot of clients, and really what they're trying to get to is financial freedom. Often it's a case of being able to make work optional at some point. The likelihood is that they'll probably continue working, but they want to know that it's going to be a choice. Now, everyone's version of financial freedom is going to be different to somebody else's, is different sort of from financial independence as well. So really, to get a handle on what financial freedom means to you, it is kind of a starting point that I'm going to touch on. But I did like this quote from kind of Tony Robbins: success is doing what you want to do, when you want, where you want, with who you want, as much as you want. And I think that, really applies to financial freedom. That's what it could potentially allow you to do on that. Okay, so the starting point, again, and what I often find the mistake that people make is they sort of go headfirst into, what pension should I have, or what investments do I need, and what funds should I be in? And really, they need to take a step back and have a think about, what purpose do they want money to serve? Money is the fuel to enable you to do things. It's not the be all and end all. So you want to get really clear on what the money's for. Set some priorities within your life and things that you want to achieve. Get really specific around that. Look at the bigger picture. What really matters to you. How do you want to be spending your time? Who do you want to be spending time with? When do you want to be able to potentially stop work? Do you want to be traveling? What are you going to need? Really get clear on that and get that vision, and that's going to give you that focus when it comes to actually planning out what you need to do to make that achievable. And ultimately, it needs to be something that excites you and gets you fired up as well. And with everything, it's a balance between the two on things that you're doing. Okay, so future's going to happen regardless of what we do. Fingers crossed. Time's going to pass, and basically the action that you take today is going to dictate the future that you've got. So we're all going to have a future, but what that is going to look like from a financial perspective, and more importantly from a lifestyle perspective, is really going to be dictated by the actions that you take over that time. So I would say there's probably 4 futures that you've got. You're not taking any kind of action, not kind of doing anything. Potentially you could have a real problem when you wanted to be able to stop work, not having enough money, potentially running out of money in the future. That's obviously going to be a problem future. It's not what we want. Other option, you might have an uncomfortable one. So not as big a problem, but not ideally the future that you want. Maybe you've got to spend quite a bit less to be able to do the things that you want, reduce that kind of lifestyle. Ideally, what we want is at minimum to get to that comfortable future where you know that there's going to be decent amount of money available, can be able to do the things, you're going to have some version of financial freedom that you want. But ideally, what we really want is to be smashing it, having that great future, having taken the actions today that enable you to do it. So you can live this great lifestyle and do all the things that you want to do. And obviously, as time moves on, it's hard to jump between, the lines from problem to uncomfortable, to get from uncomfortable to comfortable, and, from comfortable to smashing it. The longer you leave it, the harder it's going to be, which might mean you're going to have to put potentially more money in and make more kind of sacrifices, because otherwise you're just going to kind of drift away from the future that you really want. So taking action now, having a really clear plan, constantly reviewing it, is going to potentially allow you to leap up through it. So even if at the moment you're on track for maybe an uncomfortable future, you can take the action that is needed to move you up into the comfortable, and ideally the smashing it, and get really clear on what you need to be doing. So I like that way of kind of thinking about things. So what do you actually need to do? What do you need to kind of consider? For me, there's 3 really key areas. It's getting the right strategy in place, putting the systems in place to make the strategy kind of work, and then finally the solutions that you've got in place as well. Be that your pensions, underlying investments. So these all kind of link together. But those are the 3 kind of areas that I would sort of focus on in terms of what you need to do. So if we take, and I'll be reviewing that, kind of reviewing the strategy, reviewing the solutions, making sure that they're suitable. Okay, so with regards to the strategy, here's some sort of ideas and things you need to think about. One of them, you need an action plan. Okay, so you're going to need to have something in place, understand what your strategy is and that action plan to achieve what you want. You need to consider how much you need to save, how much you could save, what return you would actually need to achieve your goals, how much risk do you need to take to achieve those objectives, how should you construct your kind of portfolio, what are your trade-offs. Again, working with clients, one of the things we can do is look at different scenarios and the impact of different kind of financial choices and different financial strategies to show, well, if you do this is potentially what you could do. So for argument's sake, you might have to take less holidays now so that you could retire earlier or start working earlier, or potentially that priority might be, well, to travel more now, but that means you're going to have to push your kind of pension back, or sorry, your retirement back, and things like that. So getting clear on some of the trade-offs as well is important. Can you maximize your pensions and your ISA allowances? What's the best kind of vehicle for you from a strategy perspective? With regards to the business, growing your business, if you're a business owner, because obviously that's going to dictate how much potentially money you can bring into the household, or how much money you can put into pensions. Often carry out this with obviously there might be a business sale at some point, but if you're in the early 40s and running a business that you're planning to sell 15, 20 years potentially down the line, obviously we don't know what that landscape is going to look like and how much the business will be sell. It's not something that you want to rely on in terms of making your financial life plan work. Being able to sort of take advantage of the success through building up your pensions can ensure that you're not completely reliant on the business sale. So certainly something that you want to consider. But if you're a business owner, can you generate can you grow your business to generate assets in another kind of way? Again, what I often find is people are quite all over the place when it comes to their finances, the structure that they've got in place, the systems that they use. So I think it's really important if you have like a spending plan in place. I'm not talking about budgeting, but obviously you kind of need to know your numbers, but have it structured in a way that it's simple, works for you. So perhaps you can do personal accounts for different areas of your life. So you can have your fixed bills like your mortgage, your electricity, etc., general spending, which might be food, and then pleasure and leisure, lifestyle, whatever you want to call it as well. But really useful way of setting them up, so you can keep track of these areas of your lives and know that you're not kind of having creep in different areas. And then make sure that you're putting stuff aside for future you, and really that should be the starting point. Make sure that you're taking care of future you before you're doing anything else. So maybe that's paying off extra amounts on debt, but building up your savings, your investments, your pensions. So you want money to be flowing to future you. What you don't want to be doing is taking money from future you back into the present, ideally. So getting a nice system in place and then automating that system so it just works for you, doesn't have that effort, and you know that you're building up pots of money elsewhere. You're building for your future without having to go in and be on it all the time. So I think having the right structural system in place is really useful. And then finally, what are the solutions? What do you need to have in place? What's the best pension for you? Personal pension. Is it a SIP? Is it a SAS? What are your options? If your business owner is commercial property, something that worth considering. In which case you might be looking down at a SIP or potentially a SAS, whereby obviously the pension owns the commercial property, and then you essentially pay rent for that property into your pension or someone else's. What are the right ISAs for you? Cash ISAs, stocks and shares ISAs. What funds should be invested in? What are the charges? What level of risk? What are the right solutions for you to kind of make your strategy work? Obviously, the strategy is going to give you that overview. You're still going to need the right products in place to make that achievable. Again, rental properties, you might decide to do it down that route, building up, rental properties, much less attractive now because of the, again, tax changes, not being able to claim tax relief, the additional stamp duty. But, that could be an option to make your strategy kind of work, all obviously align with that bigger vision. One thing I say about rental properties is if you're going down that route, to make sure you get the right structure in place initially, which might be setting up a company to hold those rental properties on that side of things. So just to recap, I've gone slightly past, but actually not kind of too bad because I started a little bit late. But my kind of 3 key takeaways that I would have would be, if you're earning over £100,000, look at protecting your personal allowance with those pension contributions, certainly between that 100 and 125,140. Be making those pension contributions. If you can keep your spending at the level of £100,000 worth of earnings and put the rest into a pension, from a tax perspective, that's going to be really, really important. But make sure you're obviously claiming back your tax on via self-assessment. Make use of carry forward where possible, particularly if you're kind of a business owner. Be aware that there are a lot of rules and considerations that you need to be aware of, but definitely something to explore and look at doing if possible. And then finally, get really clear on your version of financial freedom. What does that look like? What do you want to be able to do? And then you can put in place the strategy, the systems, the solutions that you need to kind of achieve your version of financial freedom. And it doesn't matter what anyone else's is, it's what you want as well. So to get really clear on that vision, I think, is really, really important. Okay, so that basically brings us to the end of the webinar. I'll go through some questions. I know there's a couple in there already, if anyone's got any more. But basically, I wanted to share a little bit about what I do. So provide comprehensive financial planning and advice in sort of all areas, be that investment management, product advice around pensions, investments, ensuring you've got the right insurances in place, cash flow modeling so that we can see, potential futures, tax planning on that side of things. We'd like to take a really personal approach in terms of how we go about doing that, to really get to know you and understand what really matters to you and why, and then build that financial plan to create the life you want. And there's sort of 3 elements to that. There's obviously the life side, the money side and the purpose, and they all kind of fit together. But ultimately, want to empower, our clients to make smart financial choices so that they create their version of financial freedom. That's really what it's all about. So I'm going to just have a little look at the questions. I just wanted to share a testimonial from a client while I'm kind of looking through that. If anyone does have any more questions, do shout out or comment in the chat. I will look to cover them off. I can see a couple of them that have come through, which I'll cover off in a second. But yeah, I really like this. I think that, really emphasizes the need to do it sooner rather than later. From a kind of a business owner, it's easy to put these things off, but as you see from that kind of 4 futures, the longer you leave things, the harder it can be to kind of get back on track on that side of things. So if you do want any more information, if you do want to get in touch, you can obviously visit my website. You can book in a call on there. I will share a link in the chat as well. Emails on there, mobile number on there as well. I presume a lot of you follow me on LinkedIn. But you can follow me there, or you can obviously go on Instagram. I'm also on there as well. So I'm just going to see, give me 2 seconds, if I can share. Oh, I can't comment to it. Can I not? Okay, I can't post it there. Hang on a second. I'm just going to see if I can do it elsewhere. Okay, I'll do that in a minute. I'll just answer the kind of the question. So I think one of them that we had was with regards to the pension being passed on to dependents in the event of death. Would this happen by default, or would you need to contact your provider? I presume you mean obviously you'd have to notify them that there'd been a death, but it will pass to your dependents. It goes through a process in order to do it. So having something like a death nomination form is really important to identify, who you want to benefit from it. It will work through the system anyway, but it's really important that you have that in place. And again, things like if you're, most people might have their spouse or their partner named on there, but not the children, to have something where even if it's 98% that goes to your spouse and 1% that goes to the kids, just so that they know, and God forbid something happened to the two of you at the same time, they know who want to do it. But they'll be looking at the will as well, and obviously they determine the decision. But in the majority of cases, they'll go off what the the death nomination form, as long as it's aligning with your will. But definitely have that in place, because it's just going to make it easier from that side of things. It still takes some time for this to kind of work through the system as well. It's not a quick thing. So they had a couple of experiences with this, but yeah, it's certainly something to get in place. Just having the death nomination form doesn't mean that it will automatically stay in a pension. It will depend on the type of scheme. You'll need something that facilitates what's called flexi access drawdown. If it's like an old style scheme, it may just pay out a full lump sum. So the dependents will still get it. It's just how it kind of works through. So again, death benefits are something to really be aware of. And again, I'm talking from a defined contribution side of things. Okay, and then I've got one with regards to inheritance tax, how it's calculated, and the percentage, please. Yeah, I didn't cover off inheritance tax. It's a webinar probably all in itself. Simplest way to kind of explain it. So you have a nil rate band, which is 325,000. You also have what is called the residential nil rate band for residential property. So that's like another 175,000. So each person, in most cases, will have £500,000, of available kind of allowances, assuming obviously the property is valued at that much. It does get tapered off as everything seems to do. So if you have particularly high um, an estate that's worth quite a lot, into the millions, then potentially you could be reducing your residence nil rate band. So it's not quite as simple as you'd expect it to be. But anything that's basically add up all your assets, take away your liabilities, and anything left, if it's over those allowances, those nil rate bands, then you'll pay 40% tax on it. Pensions sit outside of your estate from an inheritance tax perspective. So again, a really reason why they're really useful tool for building wealth. There's other assets that might not form part of your estates, but it's probably a bit too complicated to go in here. But if it's something that you're obviously looking at or is a concern, it's definitely an advice area because the potential kind of tax savings will be kind of significant on that side of things. Okay, I can't see any sort of more um, questions. What I'm going to do is I'm just going to wait a couple of minutes if anyone's got anything, either on stuff that we've kind of covered off, um, or with regards to something else. Like I said, I'm happy to kind of stay around. I'm thinking I can put a link in the comments, so if anyone does want to book in a call, you can do that. I can't seem to do it through StreamYard. I don't know if that's showing, or the easiest way is to kind of jump on my website and go through it on there as well. So I'll I'll wait a couple more minutes if anyone got any questions, but really appreciate everyone that's attended. Um, Make sure that I've got your email if you want to drop me a DM with your email in it, so I can send you the recordings. Fingers crossed that it has recorded. Otherwise, I'm going to have to go back and do it manually, but I'm pretty sure it automatically records. But if there are any more questions, like I say, I'll wait around for a few more minutes. Or actually, as well, if anyone's got any suggestions for future webinars, topics that they'd like to kind of cover off, you can obviously post that in the comments as well. It'd be interesting to know. We're keen to do some more of these and really tailor around to what people are looking for. Okay, well, I'm guessing that that's everyone who wanted to kind of ask a question. Really appreciate all of you that did attend and the people that signed up. Hope the recording is useful. If can be of any further support, so do get in touch. But yeah, I'll be looking at doing more of these webinars kind of moving forward as well. So um, if you've got any topics that you want to share, Jason, yeah, I'll send across the recording to you as well. Um, but yeah, thanks everybody. I think it went pretty well from the recording. We'll find out if I've actually recorded it. But yeah, I appreciate you taking the time out at lunchtime to learn about this stuff. So I will speak to you all soon. All the best. Have a good afternoon.